But ever since we created the central bank, the dollar has lost more than 99% of its value. So now you need $5,000 to buy the same ounce of gold that you could buy for just $20 before we had a central bank. So that trend is going to continue. As long as we have a central bank, it's going to be debasing the dollar. I just think the rate of decay is going to increase. So gold prices could go to 10,000, 20,000 in the not too distant future, 5-10 years from now. But it's not because gold is changing. It's just because the dollar is losing value. You just need more dollars to buy the same ounce of gold.
The dramatic devaluation of the US dollar is a mathematical certainty as long as a central banking system continues to prioritize currency debasement over sound money. Since the inception of the Federal Reserve, the dollar has surrendered more than 99% of its original purchasing power, shifting the price of a single ounce of gold from a mere $20 to over $5,000. This historical trajectory is not a sign of gold becoming more expensive, but rather a reflection of a dying fiat currency that requires an ever-increasing volume of notes to acquire the same unchanging physical asset. PeterSchiff, a veteran economist and outspoken advocate for gold-backed stability, warns that the rate of this monetary decay is set to accelerate significantly over the next decade. He projects that gold prices could easily reach $10,000 or even $20,000 in the not-too-distant future as the central bank continues to monetize debt and erode the dollar's core value. For investors, this shift represents a fundamental price reset, where nominal gains in dollar terms simply mask the total collapse of fiat purchasing power. Positioning in physical gold is no longer just a luxury. It is a vital necessity to escape a system designed to inflate away your life savings. Now, we present the clips from PeterSchiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think the rotation into gold, central banks started rotating out of dollars into gold a couple of years ago. And that transition is ongoing and will accelerate. But private investors have barely even scratched the surface. I think we've seen a little bit of money moving into the gold sector this year, and now maybe some of it is already coming out. People are scared now because it's going down. But I think we're very early in private flows, private investment flows, pension funds, endowments, hedge funds. And I don't even think the retail investor really got sidetracked over the last couple of years into crypto, which is very unfortunate because they're going to lose a lot of money in Bitcoin and other crypto-related investments. The money that was made in crypto was made by all the people who's cashed out, right? That's how you make money in Bitcoin. You sell yours, right? The people who buy it are going to lose money. And a lot of people over the last couple of years, as foreign central banks were buying gold and the price of gold was doubling, Americans were selling their gold and buying Bitcoin. And now the price of Bitcoin has been cut in half. But those trends are going to continue. But when the public realizes that they bet on the wrong horse, they'll move over to gold. And so that hasn't even started yet. So I think $5,000 gold, now it's $4,800. I think this is cheap. I don't think gold is going to stay under $5,000 for long. So people should be buying it, going and get it at Schiff Gold. Silver's at 75. Silver got up to 120. So it's had a big pullback, but it had a massive breakout. There was a double top just below 50 going back to 1980 and then 2011. And we blew through that. So silver's in a brand new, huge bull market. So people should buy any dips in silver. So you can get both metals, at Schiff Gold. And we have strategies that are specifically focused on gold mining stocks. Those are the ones that I think have the most upside potential. And people, if you're underweight, you really need to get into these miners. I think they're ridiculously cheap. Wait till you see their earnings. The earnings that these companies are going to be putting out in 2026 should blow away estimates. And all these stocks are very cheap, even given the estimates that they're going to blow out. So they're not even factoring any of this in. So, we have separately managed accounts, but people could also buy my gold fund, pretty much any discount broker. We have a no-load share class, institutional share class. EPGIX is the symbol for the no-load gold fund. Today would be a great day to buy it. Markets are closed, but, buy it as soon as you can. Well, look, I don't have a target because gold, gold's going to keep rising. Remember, when the Federal Reserve was created in 1913, gold was $20 an ounce. And so now you need $5,000 to buy an ounce of gold. An ounce of gold is no different than it was when the Fed was created. What's different is the dollar. The dollar that we entrusted the Fed to protect collapsed, and the dollar lost more than 99% of its purchasing power. Whereas, when we established the dollar as 20 ounces of gold in the Coinage Act of 1789, gold was $20 an ounce. And in 1913, when the Fed was established, again, it was still $20 an ounce. So when we had a free market and no central bank, the dollar maintained its value, and you could buy an ounce of gold for the same price in 1913 as you could in 1813, right? You had 100 years, the dollar maintained its value. In fact, the price of everything else went way down. So the dollar held its value in terms of gold, but it gained a lot of value in terms of goods and services. But ever since we created the central bank, the dollar has lost more than 99% of its value. So now you need $5,000 to buy the same ounce of gold that you could buy for just $20 before we had a central bank. So that trend is going to continue. As long as we have a central bank, it's going to be debasing the dollar. I just think the rate of decay is going to increase. So gold prices could go to 10,000, 20,000 in the not too distant future, 5-10 years from now. But it's not because gold is changing. It's just because the dollar is losing value. You just need more dollars to buy the same ounce of gold. Well, it would be worse than 2008 if the Fed did the right thing. But because it won't do the right thing, because it knows that doing so would create a worse financial crisis than 2008, it won't. And so what's going to happen is not going to look like 2008. It's going to be a different type of crisis. I think it's going to be a U.S. dollar crisis, a sovereign debt crisis, and you're going to have very high inflation. And so I think the real losses that average Americans and investors are going to suffer as a result are going to be greater than the losses that were suffered in 08, 09. And in fact, if you held on, even if, the stock market got cut in half and you didn't sell anything and you held on, the government bailouts bailed you out. The market came up and made new highs. But this time people are going to get wiped out, and the bailouts or the attempted bailouts will just wipe out what's left. So it's, the government's going to make it worse this time for investors, and all Americans are going to suffer the consequences of these misguided policies. Well, the right thing to do, it would be to stop doing the wrong thing. They have to completely do an about face. Interest rates need to be much, much higher. They have to go higher than they were. The Fed started cutting rates in the summer of 2023. The Fed funds rate was at 5.25. Now it's 3.5. They got to reverse all that. We got to get back above 5. Probably, though, at this point, we probably need to go above 6. But there's no way they're going to do that. They're not going to pull the rug out from under the entire bubble economy. They're not going to crash the housing market. They're not going to crash the stock market. But the alternative is worse. The alternative is that you keep creating inflation. And if you look at the value of the U.S. stock market today, the Dow is worth less than 10 ounces of gold. Now, in 1999, the Dow was worth more than 40 ounces of gold. So you're talking about a 75% decline in the value of stocks, even though the nominal price of stocks has gone up almost 5-fold. But in real terms, the stocks have lost value. And that trend is going to accelerate in the years ahead. So I think the Dow could go down to less than 2 ounces of gold in the next 5 to 10 years, which is another 80% drop in real terms. Now, during that same period of time, the Dow might go up. Who the hell knows? But it won't matter if it goes up, because you're not going to be richer. You're going to be poorer, even if you own the Dow.
The current shift of global central banks away from the US dollar and into physical gold is a profound structural transition that is only just beginning to reach private investment flows. While retail investors were largely distracted by the volatility of cryptocurrencies over the last few years, the fundamental debasement of the dollar has continued unabated. Since the creation of the central bank, the dollar has surrendered over 99% of its purchasing power. Where $20 once bought an ounce of gold, it now requires $5,000. This trend is set to accelerate as the rate of currency decay increases, potentially pushing gold to $10,000 or $20,000 within the next decade. We are currently witnessing a stealth bear market in equities. Although the Dow has risen in nominal terms, its value measured in gold has plummeted from 40 ounces in 1999 to less than 10 today, a 75% real decline. As the Federal Reserve chooses further inflation over the systemic collapse that a right policy of 6% interest rates would cause, this real-term wealth destruction will only intensify. Investors remaining in paper assets risk being wiped out by a sovereign debt crisis that bailouts cannot fix. Let's get back to the interview.
Well, ironically, and maybe not so ironically if you're familiar with these trading patterns, but the war has helped the dollar. The dollar has rallied a bit on the war, and that's typical as a safe haven move. The war has helped to lift interest rates, and that has also acted as a short-term boost to the dollar. But I think the dollar's rally is not that big compared to rallies of the past under circumstances like this. And I think that shows you that times are changing and the dollar is not seen as favorably as it was in past military conflicts. I think it's ultimately going to be a negative for the dollar, because it's going to weaken the economy. It's going to lead to bigger budget deficits, more inflation. All this is dollar negative. And, it's just another thing that's going to upset the world, something that the United States has caused, because the world is going to be dealing with higher energy prices, higher food prices, the longer this war goes on. And, that they can just blame that on Trump. Meanwhile, Trump has already pissed everybody off with the tariffs. Even though the tariffs are paid by Americans, contrary to the claims of Trump and his administration, Americans pay the tariffs, but to the extent that imported goods are a lot more expensive because we have to pay the tariffs in order to import them, that is, bad news for a lot of foreign companies that now sell fewer goods to America. They have to find other customers, and maybe they can't pay as much as we did. And so, yes, it is, a negative for some companies. And, so we pissed off a lot of these companies. These are trading relationships that have been going on. And, I think we've also antagonized people with our threats. Like, Trump was threatening to invade Greenland. I mean, what the hell did Greenland do? Right? Greenland wasn't a threat to anybody. But Donald Trump decided that we needed Greenland. Strategically, we needed to own that real estate. And he said, if we can't get a deal, we're going to send our troops in. We're going to take it by force. Now, he never did that. I think he backed away. But the fact that he even contemplated it out loud, I think, is a big negative, because it gets people to thinking, maybe they'll do it next time. So I think we've, we're losing a lot of our, credibility. I think a lot of our allies are not as aligned with us. And I think we're driving our enemies closer together. And I think we're even driving our allies to have greater ties with our enemies. I mean, to the extent that we perceive China and Russia as enemies, I think they're making a lot of inroads. In fact, if you look at Chinese trade is growing with Canada, it's growing in South America. Even as it's declining with us, China is now doing more trade with everybody else. I mean, yeah, it's possible. I just think that the odds that this war is a success are much lower than it being a failure. Now, even if it's a failure, Donald Trump could still claim it's a success. He could define anything he wants as a success, and he probably will. Just like he claims we have the greatest economy in history, and we obviously don't. We actually have a worse economy than we had under Biden. And Biden, he says, we had the worst economy in history. So Trump can very easily lie about whatever the hell he wants, and none of the Republicans will call him out on it. They'll all repeat the same lie as if it was true. And in fact, I was listening to an interview with Chris Christie And he recalled the conversation he had with Donald Trump. And Donald Trump told him, if you repeat a lie often enough, it becomes true. Back then, the dollar was very weak. The dollar was really going down, and it was also saved by the financial crisis. So we haven't seen a big dollar weakness yet. Now, that could come. Now, one thing we've seen is gold strength. Gold was very strong leading up to the 2008 financial crisis. In fact, gold had risen from under 300 in 2000 to 1,000 by 2008. So it was a big move. And now we've had a big move in gold too, because we got up to 5,500. Gold was at 2,000 a couple of years ago. So we've got gold going up. And even though the dollar hasn't been that weak, the dollar did recently hit an all-time record low against the Swiss franc. So I think that's a leading indicator of where the dollar is headed. It'll soon be making record lows against all currencies, but it's still a ways to go for the dollar to hit like a record low against the euro or the pound or the yen. There's a long way to go. Switzerland is just a much stronger economy. So that currency, has gained a lot. And in fact, the dollar would be a lot lower relative to the Swiss franc had the Swiss government not deliberately undermined their currency to prevent it from going up, because it could have gone up a lot more. And ultimately, it will go up a lot more. $5,000 gold is one of the signposts right there. That's going on. But I think you really want to look at the bond market for a more significant rise in the bond market, because obviously if there's a dollar crisis, there is a bond crisis. The two are linked together, because all dollars are promises to pay, all bonds are promises to pay dollars in the future. And if you're losing confidence in the dollar in the present, the last thing you want is dollars in the future, because then they'll be even less valuable. So you'll see the bond market, you'll see the spreads, really widening, the tips, spreads, and the yield curve will be steepening. The dollar obviously will be dropping against other currencies. Gold will be rising. So look at those markets. Those are the key markets: the bond market, the foreign exchange market, and the gold market. And when you really see them moving in big ways, that's a pretty good sign that the dollar crisis is here. By the time it's obvious, then it's too late. Right? By the time the dollar completely implodes, we had a dollar crisis, but now what? It's too late to prepare for it. That's why, I've been preparing my clients for a dollar crisis for years and years. We haven't had one yet, but we had a phenomenal year last year. Last year was the best year I had. Return-wise, our gold portfolios well more than doubled, but even our non-gold strategies. I have a foreign dividend payer strategy where I buy dividend-paying foreign stocks, and even that was up better than 60% last year, and it's doing even better this year. And so I think money is already shifting out of the U.S. into international stocks. Donald Trump talks about all the money coming into the U.S., but from my perspective, money is fleeing the U.S. because the U.S. pretty much has the worst performing stock market in the world in 2026. All the other markets that I'm investing in are doing much, much better. And it's not even close. U.S. is down on the year, maybe 5-6%. Foreign markets are up, even with recent declines. And so I don't think it's costing people money to protect themselves from a dollar crisis, because I think right now portfolios that are designed to benefit from a dollar crisis are already substantially outperforming U.S.-focused portfolios. But once we get a dollar crisis, then that outperformance will be dramatically higher than it is now.
The temporary rally of the U.S. dollar as a geopolitical safe haven is a deceptive precursor to a massive structural collapse. While recent military conflicts and rising interest rates provided a short-term boost, the dollar's failure to achieve significant new highs compared to past crises reveals a critical loss of global credibility. As the war drags on, burgeoning budget deficits and accelerating inflation will inevitably weaken the domestic economy. Strategic blunders, such as antagonistic tariff policies and threats against allies, are actively driving international trade toward China and Russia, leaving the U.S. increasingly isolated. The most reliable indicators of the impending dollar crisis are already flashing red. Gold has surged from $2,000 to over $5,500 in just 2 years, and the dollar has hit record lows against the Swiss franc. The bond market is equally precarious, as a loss of confidence in the currency inherently devalues future promises to pay. smart money is already fleeing U.S. markets, which are among the worst performing globally in 2026, and rotating into high-yield foreign dividends and gold portfolios that have recently doubled in value. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Thanks for watching.